Hi everyone, this is Thomas Newman from the CIMA Hub. It's the 9th of November 2016 and it has been a singularly weird day in the history of Western democracy with the election of Donald Trump in the United States. Never fear, the CIMA Hub is here with a voice of reason in these crazy times, okay? So I should mention that the CIMA Hub is a recently formed website. Go along to the site, subscribe. It'll only take a second. Our subscribers can avail of some really high quality free materials for this particular case study, which is the Strategic Case Study, November 2016. There's a free financial ratio analysis document that all our subscribers will get. Go along to the site. There are many other high quality free articles there. And I think you'll gain a lot from browsing the website and subscribing, of course. Okay, I want to talk about the strategic case study for November 2016. The company in question is ADF, which is a dairy producer. And we're going to look at the financial statements today. Starting with the profit and loss statement, these are the things that jump out. There's been a worrying decline in revenues for the year, and that is affecting the profits. We'll see in a little while that the operating profits, in fact, are well under control. They've come up by, I think, 1.2%, if I remember correctly, over the year. So there's no problem there, but there is a big problem with the gross revenues coming down 6.7%. We'll see the reasons why shortly. Interesting that there's no specific line for cost of sales in this pre-scene, and there are a few ways to come at that problem. The cost of sales, of course, is an important figure for the calculation of many ratios, the gross profit margin, as well as other ratios like payable days, etc. So we'll see there are two options that you have when it comes to cost of sales and calculating some of those ratios. As I mentioned before, operating costs are well under control. They've risen very little over the year. So we'll take a look at that as well. And the falling profits, which are linked to those falling revenues, lead to problems with, or rather the potential problems, I would say, with the company barely earning enough to cover its interest payments. Debt is a problem for ADF. It's improving, but it's still a problematic issue for ADF. So starting then with the revenues and the profitability of this company. There's been a 6.7% decline between 2015 and 2016 in the total gross revenues. You'll see that milk sales make up a huge part of that revenues. They make up 94% of the total gross revenues. So that's where ADF needs to be really concentrating its efforts. Is it because there are lower quantities of milk being sold, or is it because ADF is having to sell its milk for less than the market rate? The market rate is about 27 dollar cents per litre, we're told in the pre-scene, and it's been on a downward trend since the start of 2014. So it could be that, in fact, ADF is getting even less than the market rate, which it could be the case because ADF is still a small independent farm compared to some of these industrial farming giants. It has less negotiating power in the face of what are some very, very powerful buyers. The buyers in this industry, of course, are the supermarkets. They have enormous power. I have reason to believe that it's because lower quantities of milk are being sold by ADF this year. It is mostly to do with the fact that they have a lighter asset base from which to produce revenues. We'll see that more closely when we look at the balance sheet in a few minutes. but a worrying decline overall in total gross revenues, and there you go. The profits then are affected adversely because of that decline in revenues. As I said, it's not that costs are spiraling out of control. We'll have a look at the operating expenses in a minute, but they're rising very, very gently between 2015 and 16. So the issue is one of revenue decline hurting profitability. And there we have the operating profit and the net profit figures for the 2 years, 2015 and 2016. What we see with operating profit is there's a 40% decline over the year. You can see the operating profit margins, whereas it was 19.4% in 2015, it's come all the way down to 12.4% in 2016. The net profit then, an even greater decline, 55.3% decline, with the net profit margin falling from 7.7% to 3.7%. So at least this company is profitable, but that is a big decline in profitability for the year. Cost of sales, so a little bit of a mystery. There is no cost of sales figure in this pre-scene. What are we to do? Well, we have two options. As I said before, cost of sales is a figure that has importance when it comes to calculating some important ratios like payable days, inventory days. It's relevant for all of those, and of course the cash conversion cycle, which takes into account the payable days, the inventory days, as well as the receivable days. So we need a cost of sales figure or some proxy that will serve. So I see two possibilities here when we're faced with this situation. We could calculate a cost of sales figure. The problem with that is that it's a little bit subjective. When you look at the long list of operating expenses on the profit and loss statement, it's quite difficult to isolate the ones that are, let's say, that are pure indirect costs. The ones that you would class as just operating expenditures, the ones like administrative expenses, distribution and sales, etc. But it seems to me that there are a few of those actually on the profit and loss statement for ADF. Another alternative is to use the operating expenses, and I favour this option for this particular pre-scene. It's a little bit more simplistic. The cost of sales, you'll remember, relates to things like raw materials, direct labour, storage costs, factory overheads, etc. And when I scan the profit and loss statement, it seems to me that most of the expenses there fall under one of those categories. So it's simpler to use the operating expenses also as the denominator for our ratio analysis for those payable days, inventory days, etc. And it's interesting to look at a real life example as well. It can guide us here. If UK's Dairy Crest, which is a large dairy producer, when you look at their publicly published accounts, it's interesting to note that of all of their expenses, 80% are assigned to cost of sales. So this seems to be an industry where most of the expenses are coming in under cost of sales. If something like this comes up in the exam, it's important to just briefly mention and to justify your position, whether you're opting for a subjective calculation of cost of sales or you're just using all of the operating expenses from the profit and loss statement. I mentioned that operating costs have been controlled quite well by ADF. I wonder, in fact, has it got less to do with wonderful cost control on the part of ADF, and has it got more to do with the generally low rate of inflation that we've seen in Western countries in recent times? I suspect it has more to do with that. The total increase in all of these expenses is just under 40,000 dollars for the year. That's a 1.4% increase. So no major issues there. It's interesting to note that 50% of the total operating expenses fall under these just two sections of the operating expenses. Purchase concentrates and staff costs. These are accounting for a big proportion of total operating expenses. It's interesting to note that they're running ahead of inflation. So each of those has risen 3.1% between 2015 and 2016. If you want a reference figure for the general rate of inflation, the OECD rate of inflation for 2015 was just 0.6%. So the OECD is this group of developed countries, and maybe ADF wants to take a look at why those big expenditures for them are running quite a bit ahead of inflation. It might be a concern for them. The vet fees, simpler, have actually come down almost 5%, and it begs the question as to whether ADF is maybe skimping on some of those costs. They're important fees. We're told in the pre-scene that vet visits are frequent on a farm, and they're costly. It's a necessary cost, a necessary evil. So perhaps ADF has cut some corners there. Interest cover. So you remember that interest cover is profit before interest and tax divided by the finance cost for the company. And what we see is that operating profit, it's covering the finance charge. You'll see that it's 420,000 for the year, and that finance charge has actually come down over the year to 261,000 from 336,000. But in fact, because of the declining profits, which is caused by the decline in revenues, the interest coverage for ADF has fallen from 2.1 to 1.6. What this means is that if ADF is to continue on the same path, if they're going to see another decline in revenues next year, then they're not going to have enough in the way of operating profits to cover their finance expenses. It's a positive that ADF has paid off 22% of its long-term loan and 22% of its short-term loan, so that means a lower finance charge. But as I say, interest coverage is now it's demonstrated a worrying decline. I would recommend actually that ADF negotiates with their lender. The interest rate for ADF is about 8%, and a big chunk of their total debt is long-term in nature, and that seems to me to be a high interest rate to be paying on long-term debt. I think ADF is in a good position now to go and negotiate with their lender over that interest rate, because they've demonstrated, let's say, that they're a responsible client who's looking to pay down its debt maybe ahead of time, and they can reasonably go to their lender and try to get that interest rate down. What about the balance sheet? These are the things that jump out for me. The first thing is that it's obvious that assets are being shed to pay off debt. Okay, the decline in non-current assets is close to $1 million dollars, and you'll notice that the combined decline in short-term and long-term debt is roughly the same. It is exactly $1 million dollars. So assets are being shed in order to pay off that debt. And this is what I think is affecting the revenues for the year. It's necessary that ADF has low current assets. We're talking, after all, about inventory of milk. Okay, milk is a very short shelf life, and you can't have it sitting around for long. It makes sense that there's not much in the way of inventory, and that affects the current asset figure for this company. There's a low cash position, and I think there's a liquidity problem witnessed when we look at the balance sheet. So let's take a look at these in more detail. Assets and debt. So this is an asset intensive industry. Current assets, as I mentioned, are going to be low because of the nature of this industry, because milk can't be left to sit around. So low inventories and generally low current assets. Non-current assets are going to be high. We're talking about an asset intensive industry. Think of the livestock, the land, the milking equipment and machinery, the sheds, etc. that are needed to churn out, excuse the pun, these products. And what we witness is that the assets, the non-current assets, are down $966,000. And that matches, first of all, if we jump down to the bottom, it matches the decline in debt, which is down by $1 million. You'll see the non-current loan is down 22.2% to about 3.2 million. And the short-term loan is down 22.2% also, from 300,000 to 233,000. So ADF has been quite responsible in paying down that debt, and it's quite important that they did. The gearing was a little bit high. It stood at 39% in 2015. Now it's down to 30%. So they've made good progress there, and credit is due to them. But it's come at a cost. They've had to lighten their assets. Either they've sold assets off, or they're, let's say, not replacing some of their assets. It's probably a combination of both. And it's also interesting to note that that decline in assets, which is 6.4% decline in total non-current assets for the year, you'll see it comes down from $15.1 million H dollars to $14.1 million H dollars. That decline of 6.4% almost exactly matches the decline in revenues. The decline in revenues was 6.7%. So this suggests to me that the decline in revenues is a problem with quantities being sold. Okay, there's a lower asset base, which is leading to lower output in terms of milk quantities, which is leading to lower revenues. So more than it being the decline in revenues being an issue of having to accept less than the market price, it's more one of a fall in the asset base, and that being reflected in the fall in revenues because of lower quantities sold. Just briefly to mention again that this is non-current assets are not going to be too high in this industry. We're talking about an inventory of milk. After all, it's necessarily low. So the inventory is 42,412 H dollars. When you compare that to the entire assets of the company, which is 14.5 million, really it's nothing. It's less than 1% of the total assets of the company, and necessary, as I say. Inventory days stands at just 5 days, low and necessarily low. I'm using the operating expense figure as the denominator for inventory days, as I explained before. It's just a simpler way of doing it. Cash and liquidity, these two go hand in hand. That's a low cash position, 64,735 H dollars. Compare it to the non-current assets, which it stands at 14.1 million in 2016, the non-current assets. What can ADF realistically achieve or do or invest in with that cash? Absolutely nothing. Given the asset-intensive nature of this industry, they're not going to get far with 64,000 H dollars of cash. So I find that quite worrying that their cash position is quite low. The quick ratio then stands at 0.6. You remember that the quick ratio takes out inventory. So we're talking about current assets minus inventory over current liabilities. And the industry average has been suggested by a few different sources. By Reuters, for example, puts that in average at 1.1. So ADF is below that industry average, and it's a bit worrying, I think. The two reasons for this low quick ratio, one we mentioned before, is the low cash position. And secondly, I would say, is the impact on current liabilities due to the short-term debt. They're making progress on short-term debt. It's come down, I know, for the year, but it still makes up more than half of the current liability total. I think it would be wise for ADF, when they're negotiating with their bank over the interest rate, I think it would be wise for them to restructure the debt. So to move that short-term debt into its long-term loan. So to roll it up, to eradicate short-term debt, it would improve their quick ratio. It would also have a good impact probably on the interest rate that they pay, because short-term debt normally attracts a higher interest rate than long-term debt. So it's something they could consider. And it's here you have at the bottom of this slide an extract from the pre-scene. Kevin Doherty, you'll remember, proposes this business plan towards the end of the pre-scene, and he mentions in that the Andersons, who are the owners, the family that owns ADF, have neither the time nor the wealth to become directly involved in managing or financing his farm. This is a potential opportunity for ADF. He's presenting the figures for his business idea, which is this organic farm. ADF needs revenue growth. They need something different. And Kevin Doherty comes to them with his business plan, and he's already ruling them out. He knows that they're light on cash. So that's a shame. They're going to pass up opportunities. They're not able to invest in different projects or to consider any acquisitions or anything like that with the low cash position and low liquidity that they have. So in conclusion, I would say that ADF needs revenue growth, and they need it as soon as possible. They could try to make more with less, so they've lightened their asset base. Can they produce more in the way of revenues given the lower asset base? I don't know. That would be a challenge. Either they improve their the efficiency and of its operations, or they try to sell for a higher price, which is going to be a huge challenge for a small independent farm dealing with the supermarkets, unless of course they move into some kind of new product like organic milk or something like that. But that's going to require investment. As we said before, Kevin Doherty's proposing an organic farm, and he's already discounted the Andersons based on the fact that they have little in the way of cash. I mentioned before that ADF should be negotiating with their bank for a lower interest rate, and I think it would be wise to try to restructure their debt, roll the short-term debt up into the long-term debt. It'll improve their liquidity position, and it would likely help in negotiating a lower interest rate for a long-term loan as well. So there you have it. If you feel like more, go along to the CIMAHub.com. You'll find an excellent, freely available article on the financial analysis for ADF. And I recommend strongly that you subscribe. You'll receive a free financial calculations and ratios PDF for this particular case study. And you'll be advised of our exciting upcoming offers and free materials that our subscribers can avail of. Okay? So, good luck with the remainder of your study, and I wish you the very best of luck also on exam day.